What's up guys, it's your finance boy PV Rajan and welcome back to my channel where we talk all things real estate, personal finance, and entrepreneurship. Given that it is tax time, today we're going to be talking about the key tax considerations that you should be looking at, as well as some tax tips that'll save you money in the future. Let's start off by talking about stocks. This past year was a crazy year for the stock market. A lot of blue chip companies are up as high as 70% year over year. So I'm sure a lot of you guys made some good money in the stock market this year and are wondering, how am I going to get taxed on this? How much do I owe in taxes? How's this going to work? I don't know what's going on. So with your stocks, how it works is that you're gonna take the proceeds from sales, so the price that you sold the stock for, minus any commissions or trading fees, things like that, to get to what we call your net proceeds. You're then gonna take your net proceeds and minus it from your cost basis. Your cost basis is what you actually purchased the stock for, or if you bought a bunch of stocks, what the average cost basis is. Deduct that from the proceeds, and that net amount is gonna be your capital gain. So the way capital gains are going to be taxed is that 50% of that amount is going to be taken and included in your taxable income and thus taxed at your personal tax rate. For example, if you had bought shares in Tesla for $5,000 and at the peak sold them for $8,000, your capital gain is going to be $3,000. Now, your taxable capital gain is going to be 50% of that amount. So $1,500 will get added into your personal taxable income and get taxed at your personal tax rate. However, if you're Canadian and you traded through a TFSA, which is a tax-free savings account, assuming you didn't contribute more than your allotted contribution room, your gains within the TFSA are going to be tax-free. Let me give you an example. Let's say you had $50,000 in contribution room into your TFSA. So you put $50,000 into the TFSA and made good capital gains. Those gains are not going to be taxable as they were made within your tax-free savings account. Let's say actually during the year you ended up at a net capital loss position. For example, you gambled with GME, you paper handsed it, and now you are at a capital loss position. You're able to take that loss and carry it forward into the future and apply it against future gains and then have your future gains tax sheltered up until the same amount. So for example, let's say you sold stocks and you were at a capital loss of $10,000. You can carry that $10,000 loss into the future where you have a $10,000 gain, have them net against each other, and you don't have to pay tax on that future gain. The other thing is that you can actually carry back your capital loss up to 3 years. So for example, let's say you sold stocks in the current year and are at a capital loss position. You can carry that loss back to a previous year within 3 years where you actually had made a gain, apply that loss to that gain and recover the taxes that you paid up until the amount of the loss. Okay, so now let's talk real estate. A lot of new real estate investors entered the market this past year, buying income properties, the single families, duplexes, multifamilies, a bunch of new investors in the space. How's the taxes going to work? So if you hold the property personally, you're going to be responsible for reporting your taxes on the form T776, which is the statement of real estate rentals. You're going to put all of your rental income on that statement, as well as the expenses that are associated with the rental property. So some of your key write-offs are going to be, the biggest one usually, mortgage interest, property taxes, insurance, repairs and maintenance, utilities, tenant placement fees, plus any other direct costs that was related to the rental property and, for your rental business to generate income. Now, another interesting thing is, let's say you just purchased the property. It's an asset that needs to be stabilized. You're doing renovations. It's currently not at its market rents and you're incurring a loss on the property. You can actually net that loss against your other income to reduce your taxes. For example, if you were making $140,000 from your job, that's going to be included in your taxable income, and you had a rental loss of $20,000, that $20,000 loss is going to get net against your $140,000 to bring your taxable income to $120,000, and thus you save taxes on $20,000 at your personal tax rate. Now, let's say you partner with someone on this property and went in 50-50. How do I report this for tax purposes? Very easy. On the same form, you're going to go ahead and put the total amount. So again, total revenue, the totals for all the individual costs, and you can indicate who your partner was and what their ownership percentage was on the form. So if, for example, if it's a 50-50 split, you'd put the full amounts, say 50% is attributable to you, 50% is attributable to Jane Smith, and you guys chop it down the middle. 60-40, same thing, just split it 60-40, so on and so forth. So now if you purchase the property with a spouse who's on title with you guys, you can be a little bit more strategic on how you make that ownership split. For example, if your spouse is in a lower tax bracket, it may be more advantageous for you to allocate 70% of the income to them and 30% to you. So another popular question we get is RRSPs. How does this save me money on taxes? What's the big deal about this March 1st deadline? What's going on? Fear no more. So with RRSPs, essentially for the amount that you contribute to the RRSP, that is going to be a tax deduction from your taxable income, and thus you're going to save paying taxes at your personal rate on that amount contributed. So for example, if you are at $120,000 in personal taxable income and you contribute $20,000 into your RRSP, $20,000 is going to get deducted from your taxable income, put into the RRSP, and now you're going to only be paying tax on $100,000 at your personal tax rate. The thing you have to keep in mind is you can only contribute as much into your RRSP as your allotted contribution room. So every year your personal RRSP contribution room is going to be computed based on a CRA calculation, and you can only contribute up until that amount into your RRSP. One thing I want to mention with the RRSPs, which is very key thing to understand, is essentially with an RRSP, what you're doing is deferring the taxes until a future date. So if we go back to my example where the person was making $120,000, contributed $20,000 into their RRSP, they're getting a deduction in the current year for $20,000 and they pay taxes on $100K. Now, down the road one day, they're going to pull that $20,000 right back out of their RRSP, and the day they pull it out, it is then going to get taxed. So essentially, instead of paying the tax now, you're deferring it until a future date when you retire or for whatever reason you pull it out of the RRSP, and you'll pay taxes on it that day. So at the end of the day, Bob Hamilton and the CRA is still going to get their cut. You just get to choose when you want that day to be. An interesting strategy when it comes to the RRSPs that I see people do. Let's say you're an investor and you do private lending to generate passive income. You know, normally you would have your own personal after-tax funds and you're lending it out and generating your private lending income. Well, what you can do is you can contribute money into your RRSP, take the tax deduction in the current tax year for that amount, and then within your RRSP, you can do secured private lending and lend that money out on as a secured mortgage to generate passive interest income. So another big question that I get is how the hell do the vehicle expense write-offs work? Especially for my self-employed peeps out there, fear no more. So if you have a personally owned vehicle that you use for your business or towards your rental properties, this is how the write-off's gonna work. You're gonna take the total kilometers driven during the year, right? You're gonna take the kilometers driven for business purposes, divide it by the total kilometers, and take that percentage and apply it to the total vehicle costs during the year. So let me break it down further. Let's say you drove a total of 10,000 kilometers during the year, 5,000 kilometers was for business. You're gonna be able to deduct 50% of all of the following: the vehicle licensing and registration costs, repairs and maintenance, gas/fuel costs, the insurance costs, the interest on your finance payments, or if the vehicle is leased, your lease payments. And now we're gonna go over the general rules that you need to keep in mind. So for anything that you're gonna write off or claim as a business expense or a rental property expense, you have to keep the supporting invoice or receipt in order to claim that expense. If the CRA were to ever come back and ask you for it and you're unable to provide it, they're gonna deem the write-off to not be valid and then ask you to pay more taxes. So make sure you have the receipts and maintain them for up to 7 years. They can come back up to a 7-year period and ask you to provide those documents. One other key thing to note is that the receipts or invoice have to be the itemized receipts. So not the approved note that comes out of the debit machine once you swipe your card. It actually has to be the receipt that breaks out the nature of the bill. So when I say hold on to your receipts, I don't mean take them, shove them in a shoebox, give them to your accountant to deal with, or let them sit there and who knows what ends up happening to them. Take pictures of them, put them on a Google Drive. That way it'll be easier for you to organize, as well as you don't have to worry about the receipts fading. Alternatively, what you can do is use apps like QuickBooks or Expensify to take pictures of the receipts and categorize them accordingly. And you can even generate spreadsheets which details all of the expenses out and hand that over to your accountant. So another key thing that you guys should implement is having a separate bank account. So for each rental property that you have or each individual business that you have, you should have a separate bank account. That way, the revenue for each rental property or business will go through its own bank account, and the expenses will go out as well, and it'll be much easier for you to do bookkeeping. And if the CRA were to ever audit you and request those bank statements, things will be much clearer and broken out. All right, guys, I hope you enjoyed that video. If you did, make sure you smash that like button. And if you're not already, subscribe to my channel so you can get some great real estate, personal finance, and entrepreneurship content. Also, if you're interested in corporate taxes, if you want me to do a video detailing the various strategies in corporate taxes or things you should keep in mind when it comes to corporate taxes, let me know in the comments below and we can make it happen. Until next time.